Oil prices made a big move today, but it's not because of just one thing. Let me give you the neutral, fact-based explanation in under 5 minutes. So, what exactly happened? The markets were trying to process two different events at the same time. First, a geopolitical risk premium driven by recent unrest in Iran. And second, a changing supply picture because Venezuelan crude oil is now being routed into U.S. refineries. These two forces actually pushed the two main oil benchmarks, Brent and WTI, in different directions. Let's break that down. First up, Iran. Anti-government unrest there has raised fears of a potential supply disruption from a major OPEC producer. Now, even if the physical flow of oil hasn't changed yet, traders react to the possibility of a disruption. They do this by adding what's called a geopolitical premium to the price. In this case, it's estimated they added about $3 to $4 per barrel to Brent crude. Geopolitical risk is all about expectation and basically buying insurance in the market against future problems. That's why Brent prices ticked up. Now, for the second piece of the puzzle, Venezuela. Following recent political changes and actions by the U.S., a lot more Venezuelan crude is expected to arrive at U.S. ports and refineries. This increases the total amount of crude oil available in the United States. This extra supply helped push the U.S. benchmark, West Texas Intermediate, or WTI, lower relative to the international Brent benchmark. This is why you'll hear analysts talking about the WTI Brent discount getting wider. Recent reports have confirmed that U.S. refineries are already preparing to process this Venezuelan crude, so this supply shift is real and it's happening now. So, when you put both of these events together, you can see why today's market looked a bit mixed. Brent crude prices are feeling the risk from the Middle East and are ticking up. Meanwhile, WTI prices are feeling the pressure of more supply hitting the U.S. market, so they're lagging behind. This creates a price gap, or spread, between the two. Traders and refinery experts then try to profit from this gap through arbitrage, which involves complex shipping and storage moves. The immediate effect for the market is more volatility, not necessarily a long-term shortage or glut of oil just yet. What does all this mean for you, for consumers and businesses? In the short term, you can expect the prices you pay for fuel and heating to wobble a bit, depending on the daily market sentiment. In the longer term, what really matters is whether these changes in refinery operations and shipping patterns actually lead to increased supply reaching the end consumer. So for now, expect some price volatility as new reports on oil tankers and sanctions enforcement continue to come out. So what should you watch for next? Keep an eye on 3 key things this week. First, look for official shipping manifests and refinery run updates. These will tell you how much oil is actually moving. Second, watch for any announcements from OPEC or Iran that might restrict exports. And third, pay attention to any U.S. policy announcements about sanction enforcement or licensing for Venezuelan oil. These 3 factors will determine whether today's price move is just a temporary blip or the beginning of a new trend. If you want clear, neutral explainers on how policy and markets really work, make sure to subscribe. We'll be here to break down all the next big moves. And hey, if you've seen any credible data on oil shipments or refinery runs, drop the source in the comments below. Thanks for watching.